Good morning, good afternoon, good evening, everyone. Thank you so much for joining us on this beautiful day from across different time zones. My name is Arun Bruce, and I'm incredibly fortunate and privileged to have with me a set of fellow experts from across the world, pretty much, to share with you our perspectives on this very important topic of tariffs and what it means for your business. As we pull the presentation up, uh, I will share with you the background of each of my fellow. So, with me is Sunil. Sunil is Senior Principal at Transformation X. He is a deep expert in operations and transformation based in the Middle East. And along with Sunil, I have Madhur Singhal. Madhur is a veteran strategy consultant helping tens of companies on growth and strategy in the subcontinent and across the world. Growth is an important topic that he deals with, and it's deeply related to the tariff situation today. And we'll hear his perspectives on the topic and from the region as well. We have Anant, who's joining us very early in the day from the US, where he's based out of. Anant started his career in the semiconductor industry, which is pretty much in the eye of the storm as things stand right now. And after 10 years there, he joined strategy consulting, where he's worked with multiple firms over the last 20 years. So, incredibly privileged to have this unique collaboration across boutique firms and across geographies. And we're all here to share our perspectives on tariffs and its implications for you. My name is Arun. I'm the founder and CEO of Transformation X and a strategy consultant who's worked across Europe, the subcontinent, and the Middle East on operations and transformation. Without much ado, I will also set the topic up. We have three things that we have to discuss with you today. The first is a quick view on what the tariffs really are. And that's not a very straightforward question because, as you are well aware, these things change pretty much every day, if not every week. So we'll talk briefly about tariff developments, where they stand as of this morning, really. And then we'll talk about the implications of these tariffs for experts and leaders from across different regions, from the US, from Europe, for leaders in the Middle East, and for leaders in Asia. We'll talk about the future outlook and possible scenarios of how world trade could shift. And with that as foundation, we will then share our perspectives on what you, as the CEO or as the head of supply chain, need to do in order to get the most out of the situation. So that's the context in terms of what we have. Let me get into the first section right away, and we'll talk briefly about tariff developments and what they mean from a regional perspective. There are different kinds of weapons, and some are more brutal than others. Tariffs are a unique kind of weapon that end up being extraordinarily brutal because they hurt in fundamental ways, but they don't seem as hurtful when they're initially unleashed. So they also carry the element of surprise. If you look across time and across geographies, you will find that tariffs have been weaponized across geographies and across administrations for a long time. And if I look back for a few centuries, you have the British Corn Laws, where there was incredible amount of tariffs on imported grain in order to protect British landowners. This happened in the 18th century. What did it do? It raised food prices, it sparked protests, and deepened class tensions. There was a food crisis at that point of time. There were the McKinley tariffs around the turn of the century in the late 1800s, raised import duties to nearly 50% to protect manufacturers. It triggered significant European retaliation, boosted industrial profits, but hurt farmers and the rest of the society. And then one of the main triggers for the Big Depression in the 1920s and 30s is the Smoot-Hawley tariffs. Tariffs were imposed on over 20,000 goods to shield US economy during the Depression, but it actually worsened the situation. It triggered global retaliation and significantly worsened and lengthened the ongoing depression at that point of time. The current tariff challenge has many similarities to the past. Tariffs were imposed in 2018 in the first era of the Trump administration. And today, they've been expanded to pretty much all trade partners. So we are in a very unique situation that has a lot of parallels to events in the past, and it's very rapidly evolving. And as we move further, you will see that the average tariffs are rising up pretty quickly. What this slide shares with you is the average tariff on imported goods to the US over a period of time. And you can see from the events that I'd mentioned that the tariffs went up significantly in the late 1920s and early 30s. This was around the Depression time. They actually significantly worsened the Depression and lengthened it. Today, we're not as bad as that situation. We're not in the 50s and 60s, 60% in terms of tariffs, but our delta to what the tariffs were has a very similar pattern. Tariffs have gone up multifold to what they were just a few months ago. So the level of upending that's happening is truly significant. Now, the big question, of course, is whether this will create another 1930s style economic fallout. Will it have other sort of implications? And that's what we are here to discuss and share with you. As we get deeper into the tariff topics, I will invite Kumar to walk you through where the tariffs are today and how he is viewing it being in the US at the moment.
Thank you, Arun. When you take a look at this chart, it looks like there is a whole flurry of activity that's occurred as soon as the new administration came through in the US. And it seems to be driven primarily by three ostensible reasons. One, of course, is that there is a perceived trade imbalance between the US and the rest of the world, particularly with certain countries. And so the current administration is trying to correct that imbalance. The second is that the administration perceives that there are some reasonably disruptive acts across the border in Mexico and Canada. And he looks at tariffs as one way to be punitive, to be able to correct that behavior. The third, and probably the primary reason, is to drive people to the negotiation. So the tariffs are used as a leverage to bring parties to the table so that he can, or the administration can develop a favorable trade policy with these companies, with these countries. And by and large, it seems to be working because most countries have preferred the negotiations. And after a flurry of tariff announcements, they have been largely paused. The two places, I think, where there is some difficulty, clearly one is China, where there's been a significant tariff placed on Chinese goods into the US and retaliatory on US goods into China. So much so that there would be a definite pause in trade because of those tariffs. And the second is with the European Union, where the European Union as a joint market has been able to put up some resistance. The fact that Trump is backing on, or the administration is backing on, is that the US still is a very large market for all these countries. And that large market can drive some negotiation onto the table. And whether it succeeds or whether it does not succeed, what the unintended consequences are, we'll explore some of them here, and time will tell. If you go to the next slide, we can see some shifts that have occurred prior to the tariffs being announced, as well as shifts that are occurring as the tariffs have been announced. China, based on its experience in the last Trump administration, had decided to start decoupling its economy from the US economy. So its share of US imports has steadily declined over the last few years, indicating that it's changing how it sources imports from the world. Clearly, the banks have seen that there is a certain amount of exits that are occurring from the China market. And so they're looking to see whether they need to shift capital away from the Chinese market, which would be a very big shift for them. Certain companies, namely Tesla, Apple, and Starbucks, have started reducing their dependence on the Chinese market. And as this trade war intensified, there is also a showdown in front of Taiwan. China recently conducted exercises all around China, and all around Taiwan, and the U.S. is looking to see how it can counter that. So China is still sticking to the policy as no open war, but the indications are all there. And over time, we've seen that the number of Chinese students, which used to be very high in the US, have substantially dropped. So what does it mean from a US market perspective? What does it mean from a EU market perspective? Let's talk about those. So from a US market, there are clearly two sort of indications that are happening. One is that it is not very clear how long this will last. The expectation is that in the short term, these tariffs will be there and they can be highlighted through the executive orders. But already Congress is looking to see whether they can rein in the administration a little bit through legislation. There are midterm elections that will happen in 2 years. The expectation is that the Congress might change. If the Congress changes, then there will be a stop or break on the US policy. And then, of course, 4 years, the administration will change. All indications is that at that point in time, Trump will no longer be president, and the new US president, Republican or Democrat, may have significantly different policies. So it looks like, from a short-term perspective, the war is all through, trade war is all through with China. And China doesn't seem to be backing out. Everywhere else, negotiations have started. Some countries, very clearly so, like India. Some countries, after a little bit of retaliation, like China and like Canada and Mexico. There are some thoughts about resilience that are already starting in the US. The Congress has passed the Trade Review Act of 2020. It's been introduced, and companies like NVIDIA have started investing in the US to see whether they can increase the availability of semiconductor and other important technologies in the US. There have been three impacts from a sector perspective. The one that's most surprising probably is the agriculture sector. The agriculture sector, the US exports a lot of agriculture and dairy products. These are likely to be hit in the short run. And this is where we might see the largest impact. For example, the maple industry. There are a lot of people in the US that depend upon retailers like Temu and Shein for their daily purchases. These people are likely to be hit in the short run. Then there's likely to be a lot of angst in that population. And that might result in, we're already seeing a lot of town halls across the board in the US where there have been complaints against the current US policies. And the technology sector, the US still enjoys a technology advantage in certain key technological industries, and that export might be inhibited, leading to a little bit of shortages in other countries while they try to catch up. So the US, I think, more or less, the issue is how do we respond to the flurry of tariffs? What are the first and second order impacts that might occur? And how do we counter both the first order and second order impacts? And what is the resilience that we need to build in the industry today? For Europe, the issue is completely different. For a long, long time, Europe has depended on the US for its market, for a large market, as well as very friendly ties, both trade and otherwise, with the US. It depended a lot on the US for its defense, especially from a NATO perspective. This may not be true any longer. That is the principal impact that Europe needs to worry about. It is a little late in deciding that because it was very clear in the first 4 years of the Trump administration that NATO would be impacted. But they are starting to get wise about this. And there's short-term tactics in terms of improving its self-sufficiency in defense, in self-sufficiency in key minerals. So if you look at Europe, there are three things that we see that are occurring. One is to figure out how they play an important role in all major political events that affect them, especially the Ukraine-Russia conflict. And how do they deal with Russia independently if they cannot depend on the US anymore? The US seems to have a better relationship with Russia at the moment than it does with Europe. So how do they deal with that? And so from a defense perspective, as well as from an international relationships perspective, This has to be their primary focus. And the second is to develop a strong self-sufficiency from an energy and raw materials perspective, which still depends a lot on other countries rather than Europe itself. And the third thing that they are focusing on is digital and cybersecurity, because they, in particular, have a lot of threat both from a China and the US and Russia perspective that they need to counter. So that was the perspective from a Europe and US perspective. Arun, on to you for other regional perspectives.
Thank you so much, Kumar, for that lovely view from where the tariffs are really starting and the market that's closest to it that's also deeply affected. Thank you. Now we shift quickly to Middle East. Now, Middle East is relatively lucky. Its strategic neutrality and relationships with the big powers that be really position it slightly better than most other countries. Its geographical positioning from a trade route perspective also positions it very nicely, and we'll get into detail very, very briefly. So from a government perspective, the Middle East leaders, the countries have always been known to be in very good relationships with multiple global powers, and these times will actually test that even further. And I personally believe that the region will come out very strongly on the other side, because this is something that the region is very adept at doing. They've been doing this for tens of years, and this will be an excellent period during which those strong relationships will sort of go in the right direction. Having said that, oil price is likely to be a bit muted over the near future, because oil price is determined by global sentiments, and the tariffs have unfortunately affected global GDP expectations over the last few weeks. So unless there is a dramatic and permanent reversal of tariffs, both of which are quite unlikely, dramatic and permanent reversal, oil prices could be affected in the near future. And the region's export revenues, therefore, will certainly be under pressure. Now, on the bright side, if you look at consumers in the Middle East, you could have a bonanza over the next few months as tariffed countries such as China, which may be struggling with exporting to the US, in terms of the other products, could actually be hungry to find newer markets, either to reroute or to serve as a destination in itself. So smartphones, grains, palm oil, etc., may get cheaper in the GCC. So that's something to watch out for. Well, on the positive side, we've talked of the strong ties that will continue to help it. In addition to that, some of the financial centers in the region, Dubai, for example, has always been known as a safe haven. And because of that, in times of crisis, typically safe haven destinations tend to do better. So you could see the overall economic prospects of Dubai as a city-state beginning to improve even further over the next few months or years. Middle East currencies have been pegged to the US dollar. That has been a central foundation of their geopolitical strategy, if you will. Now, with the dollar being under pressure, that's unprecedented. These currencies will also be under a similar sort of a pressure. So that's something to also, watch out for. Now, the big opportunity that's coming out of all of this, if you look at the bottom right hand of the slide, is really an incredible manufacturing and transshipment opportunity for manufacturers in the GCC. Now, why are we saying this? Because the GCC is at 10% tariffs. And irrespective of where the tariffs for the rest of the world will land, one can be reasonably sure that tariffs for China will certainly be higher than the ones that GCC will experience in its exports to the US. Tariffs from Asia could also be higher than the ones that GCC faces when it exports to the US. So you put all of these things together, and you also see this incredible geographical advantage that the GCC has from a position perspective. And there's a huge opportunity for manufacturing to shift to the GCC. And this is something that I'm personally betting on. I think smart business leaders and government leaders are already in hectic parley with leaders from different countries to see how manufacturing can be further improved, factories can be moved here in order to serve the local demand, and as a opportunity to sort of export out of here. So I'm quite bullish for the Middle East. I think there are more positive signs than negative signs, even though persistently low oil prices could, of course, be a risk to watch out for. Over to you, Madhur, as you bring the Asia and India perspective.
Yeah, so I think from an India perspective, we are in a pretty good spot as well. If you look at the strategic position of India, political, economic, and otherwise, we're becoming a bit of a friend-shoring magnet, as we're calling it. Opportunity to attract manufacturing in particular. Now, the Indian government, irrespective of the tariffs also, uh, has been sponsoring manufacturing acceleration quite significantly through its Make in India initiative, through the performance-linked incentives, and in general, they are benefiting as a country from the China plus one or China plus Vietnam plus one, if I can call it. So, the if you look at the balance of trade for India, the overall deficit is actually reduced. So economically, India is not in a bad spot. In fact, there is moderation in imports. If you take oil out, it is even lesser. Actually, there's opportunity because of manufacturing. Excess Chinese goods that could be dumped into India. The Indian government is erecting tariff barriers so that that does not happen. We have had multiple examples of that in multiple categories: textiles, plastics, some metals, toys, and a number of other sectors. India is a consumption-driven economy, and so one of the things that we are seeing is that the thesis of setting up manufacturing in India is pretty strong because you can serve the growing local demand, and you can serve as an export hub for the global world. Also, the manufacturing capacities that are getting set up in India, or could get set up in India, would actually insulate India further from a balance of trade perspective. If you also see the exports, the composition of exports in India is a lot of pharma, is a lot of sectors, and pharma has been excluded even from the current tariffs. So overall, Indian exports have not been impacted as adversely as perhaps some of the others. To top it all, the duties on India, the tariffs on India, are in any case lower than the tariffs that have been taken across the board. So overall, the total merchandise exports, the dependence on the US was only 14%. There too, pharma is excluded. And even otherwise, the proportion or the tariffs, the percentage that's been applied is lesser than a lot of other countries. So India overall in a good spot strategically, and in a relatively less antagonistic manner with the US compared to the other geographies. So I think with that, if we move on,
Thank you, Madhur. That's a great overview. And we have a couple of comments from our viewers already. I would request for those comments to be brought up, please. So the first question from Brandon. Thanks so much, Brandon, for this for this question and comment. And your question is, if you see long-term benefits from tariffs in this situation, and while the short-term impacts could be negative. So for sure, the short-term disruption is quite painful for a lot of countries. Now, for the long-term benefits, I'm going to put you, Kumar, on the spot for your thoughts on it, and then Madhur, you as well.
So, so Brandon, a great question there. So if you look at history, countries that have employed tariffs over time to protect their own market as well as their own burgeoning industries have always have never been able to see good growth. So there have been very few cases in history where tariffs have actually led to over long-term growth. But in this particular case, if the intent of the tariffs is to drive everybody to the negotiating table and get better deals on the table with most countries, there will certainly be short-term benefits. There will be longer term benefits in terms of giving a fillip to some industries that have moved away from the US to other countries. And thirdly, EU will become more or less self-sufficient, which is, I think, over the long term, very good for EU and very good for the rest of the world. Right? In the end, my French wines might cost more than my American wine. I will be very disappointed if that lasts a long time.
Yeah. I will add a couple of comments to that. I think in the short term, see, the tariffs will get negotiated. Nobody's setting up capacities in any country or realigning supply chains for good just because of this 90-day tariff wall that's been created. After the negotiations, if the tariffs come down, or in anticipation of reciprocal tariffs coming down, actually the exporters would not be unhappy because it gives them more pricing power and more pricing leverage in the categories where they're exporting and the negotiations have happened. The second thing is that wherever the tariffs do not come down and there is a structural import substitution or export substitution in this case has to happen from a country's perspective, it will, for countries that are over dependent on the US, definitely stand to get hurt a little bit more, and it'll take some time before the capacities get consumed again. For countries like India, which have a smaller proportion of capacities deployed towards meeting US demand, uh, we'll be okay. We'll go through a short term to medium term sort of profitability pain, but it's not going to alter anything, the manufacturing landscape or the exports landscape significantly. And some of the final comment, the impact of the tariffs is anyway going to be shared. It's not as if the exporters bear the entire cost or the importers or consumers in the US bear the entire cost. We believe it's going to be shared, and a new equilibrium will get set. But we don't see this as a 0-100 situation at all for any country. I see another question here, which pertains to India, so maybe I'll take that. Actually, the question went away. Yeah. So, what advice would you give to Indian mid-cap SME exporters? So, I think my advice is three-pronged. I think one, talk to the buyers, plan out demand, plan out shipments, confirm that the shipments will be accepted and taken. They'll not get stuck at the port. Plan out the contingency on what happens if tariffs change. Because the shipment time sometimes can be 45 to 60 days port to port. Number one, so you need to sort of work with the customers and importers much more deeply. Number two is that we need to work on the costs. We need to perhaps build in the right pricing buffers or cost buffers in case a hit needs to get taken. So that needs to be priced in for all the shipments that go out going forward. And I think number three, and that's something that you can't do in the short term, but in the longer run, we really need to up the game on R&D, competitiveness, making a product exclusive, and basically, seeking higher value add in what we export, so that the exports become more resilient. But that's something that can't be done in the next 3 months or 6 months. I think there's a question pertaining to the US. Maybe Bruce, you might want to take that, or Anant.
I can take that. So what is the possibility that the US may continue with a 10% base tariff for all countries? I think the possibility is very high. I think this administration strongly believes in tariffs, although they will not, once the reciprocal deals are signed, they will get away from the higher tariff situation. But the 10% tariffs, I think, will continue until the new Congress comes in or the administration changes. I think that is possibly going to occur. 10% base tariff overall for different countries may not be a big deal, especially with countries that have other side deals involving large, like defense kind of equipment. That might not be a big deal, and that probably will continue. And most companies will try and figure out some way around that. That will not have shocks in the supply chain like the semiconductor or COVID did. Higher tariffs definitely will.
Great. And then we have another question for the Middle East. Sunil, do you want to take that? It's a question on Middle East's growing role as transshipment and manufacturing hub and the outlook for that.
Sure. No, so this is a great question. I think Arun mentioned about the fact that how Middle East is strategically neutral and stands to gain as a transshipment hub. Also, I think the region is building their capabilities to be a transshipment hub. We have seen significant investment both from UAE and Saudi Arabia in having free trade zones and building up the capabilities for transshipment. So, what is important here is for players to proactively future-proof their supply chain, they need to start looking at utilizing these capacities and capabilities in a way to break down the, the exports from China to the west or from the west to the east in a manner that the Middle East becomes the central nodal point for exports within the region, and then set up manufacturing or assemblies within this region to cater to these geographies, whether it's EU, whether it's North Africa or Asia in certain manner.
Great to see all of that engagement, and that sets it up quite nicely for the rest of the discussion. We're about 29 minutes till the end. We're at the halfway mark. Let's look at one important topic, which is on the future outlook and possible scenarios. Madhur, if you'd like to, or before Madhur, actually.
Yeah. No, it's often said that the best way to predict and prepare for the future is to study the past and draw from those experiences. Hence we decided to look at the first tariff war, which was launched in 2018 and 20 by Trump in his first term, which was more focused towards China as a country and a few select commodities like steel, aluminium, and learn from it. The rationale given at that time was similar. This was to correct trade imbalance, IP theft, and for national security. And the tariff was about 25% on metals and 10 to 25% on other commodities. Now, in comparison, the recent trade war is more global. It is impacting friends and foes alike, and it is across a wide range of products and tariffs. And the tariffs too are quite large. It's between 10% to 125% in certain cases. So, how will it impact it? Let's see what happened in 2018. If you move on, back in 2018, despite the focused nature of the first trade war, we did start seeing some shift in the global order, which was in the making for quite some time because China was trying to flex its muscles for global influence, and this served as a catalyst to this change. We saw the emergence of global south due to diversification from both China and US. China shifted focus from US to ASEAN, GCC, Africa, and EU for exports and reduced their dependability on US. On the other hand, ASEAN attracted a large amount of investment from OECD and the US-based MNCs, resulting in multiple trade agreements, cementing ASEAN's importance in global trade. So, for example, the RCEP, or the Regional Comprehensive Economic Partnership, is the world's largest trading bloc, which was formed in 2020. It caters to 30% of the world's population, 30% of the world's GDP, and nearly 28% of global trade. This is by far the largest FTA in the world today. This FTA has also furthered the internationalization of RMB as a currency of trade because the partners now have the option to trade in RMB rather than USD. So this has resulted in RMB also claiming a spot or climbing the spots, by 4 points, almost to the fourth highest payment currency in the world, behind the US dollar, of course, the euro, and the pound. So this has also helped China in a certain way. The other thing that also happened is we saw an increase in friendshoring and reshoring by global MNCs as China plus one policy started gathering steam. Multiple MNCs scouted for opportunities outside China to de-risk their supply chain, while Global South became the end beneficiary for these investments. Famous case studies of Apple, Google, HP, Dell, all of them shifting manufacturing base outside China to Vietnam, Malaysia, or India. We all know that, and we've seen how that happened. The impact of this trade war was felt in both the countries, whether it's US or China. The people of these countries also suffered. The tariffs were passed on to the consumers. So both the countries saw inflation, which was on select targeted goods, which came under the ambit of tariffs. Now, this resulted in economic hardships to citizens of both the countries. Also, while tariffs was supposed to help grow jobs in the US in certain industries like steel and aluminum, the impact of cost inflation had unintended consequences on downstream industries. So, for example, while jobs in steel and aluminum manufacturing grew, a lot of jobs were lost in the auto industry, which was dependent on the steel and aluminum imports. So, given the complex nature of supply chain today, some of these interrelationships are complex to even forecast on what will happen. But if we move on and we see, these developments resulted in structural changes in the global trade flow. So, some of which will now stay in the long term and will be very difficult to reverse given how the world is shaping up. So, to start with, trade between China and the US, of course, has reduced. So, there is a drop in that trade channel. Europe and Russia, of course, but not because of the trade tariff war, but just due to sanctions. That's another place where the trade has reduced. Consequently, like I mentioned earlier, the trade between China, Russia, ASEAN, GCC, EU, and Latin America has multifold. It has grown and will keep growing in the coming years. Similarly, from US, we've seen the trade flow to EU, Asia, GCC growing multifold. So this is gives a glimpse of what happened in the first trade war. Though it was targeted and narrow compared to what we see today, it resulted in some structural changes in the global trade flow, and it gave an impetus to the change in the world order. Now, the second trade war is far more wider in terms of the countries that are impacted, and is far more deeper in terms of industries that are impacted. So, what will this result in? Let me request my fellow panelist Madhur to throw some light on what the future could hold and what are the scenarios that could play out.
Yeah, no, I think the future world order, as Sunil, you very rightly said, we see this on two axes. There is the US-China axis, and it's, I think, fair to assume that these two will stay at opposite poles. Uh, and then there's the other axis on uh, where in product categories where the supply is fragmented, which means many suppliers, many exporters, to consolidated where there are very few sources of supply, even for U.S. importers. And so what we have tried to do, the status quo today, as you can see, is consolidated base of suppliers, and more sort of tilt toward the U.S. In terms of where the export flows are. There's a new world order which could be more China-led. There is a scenario of a multipolar world with multiple trade partnerships, bilateral trade agreements, and US sort of having a few bilaterals which are more beneficial to us and other bilaterals which lead to significant decrease in the business. And then there is that eventual sort of very bad, totally fragmented response. China, US sort of competing, the price wars, the tariff wars, it leads to a total chaos, which again we think is perhaps not so likely. So if we go to the next page, I want to talk about a few scenarios that could play out, right? And S1, S2, S3, S4 are four likely scenarios, of which we believe that the S3 is perhaps the most likely one. So I'll talk through some of the other scenarios a bit more quickly, but spend a little bit of time on what this multipolar world in all eventuality could look like. Now, if you look at the status quo, if you manage this, you get to stable economic health again, manage tensions between non-aligned partners, investments focused on resilience, friendshoring, nearshoring, the product categories, wise trade contracts and exceptions, like have been done for smartphones, relatively stable currencies, moderate inflation. This is all good. Or if you look at economic health, volatility, capex, inflation, but very less unlikely given where the situation is. If we go to the second scenario, which is really the new world order, this is where the BRICS and the global South may gain. Western economies suffer a lot. Uh, you see increased polarization, increased very polarized and jingoistic global relations, strategic realignment with investments in China and some of the BRI zones. You will see massive currency volatility. In fact, you could see a doomsday scenario on the USD because you don't know if USD stops being the basis of the currency, and especially given the Chinese yuan is actually pegged to the USD, we're basically looking at not very different from the S4, which is chaos. And there's be a massive short-term spike in inflation everywhere, right? Because exporting countries will have costs go up, so they will need to pass on those costs to the local consumers. And the countries that are importing will see, especially the US, will lead to a price reset on a lot of those products, which will also have ripple effects in other countries as well. And so, this scenario, we do not see any positive at all, any neutrality at all. This is very negative, especially for currency and for global relations. But this is again, it's too turbulent to play out, and this will lead to a lot of chaos. Let's get to S3, which is the third scenario, the most likely scenario. This is a scenario where we think regional blocks happen. China has its own strengths. India, so the Southeast Asian countries, they have their own strengths. There are bilateral relationships, not just with the US, but with Russia, with Africa, with Europe. Europe gets into regional blocks to negotiate with the US and does FTAs, free trade agreements with countries like India, Indonesia, Vietnam, etc. Right? There's complex global relations with weakening global consensus, of course, which leads to more bi-party, or multipolar scenarios. Therefore, diversified capex. So different countries will prioritize capex in different verticals or industries, and therefore this will lead to further realignment of the trade agreements. High currency volatility, because all these capex setups don't happen in a year; they don't happen in a month, in few months. This is going to be a multi-year journey to stability, and the trade frictions in any case will lead to inflation spikes in certain product categories in certain countries. Now, this scenario means that we will, by and large, have somewhat volatile economies, but not unstable. Will not lead to severe long-term recessionary pressures. But the currency volatility, absolutely yes, because the currency, if the tariffs don't come down, then there is definitely a pressure on keeping international trade pegged to the US dollar. Capex investment, I think, will happen. In the long term, it's good, but it's not going to happen in a rush, not until the entire situation on tariffs settles down and stabilizes. Inflation, we think it's going to spike, as I said, a little bit. Global relations, I think, in parts, maybe we've been a little too negative and saying red. I think in sort of combinations of countries, it might not be that red, but this is the most likely scenario that we are looking at, and we are advising our clients to prepare for at the minimum. If you look at the total chaos scenario, and again, it's probably not even worth talking about too much, but if we absolutely go berserk, if we're talking, very high recessionary risk across large global production and consumption economies, we're looking at breakdown in global relations, a nationalism and jingoism as the dominant theme before economic rationality. If we're talking about frozen or reactive capex, also who puts that capex? Because governments won't put capex. Private capex, will private equity fund that capex? Will private capex happen, from corporates in the countries? Very unlikely, not in a rush for sure. And you see a fair bit of de-dollarization, which basically leads to formation of a completely new world order, which we are not able to imagine right now. And this leads to high and unpredictable inflation across the board because of the cross-category ripple effects that you will see. So this is what we call as a sort of the worst case of the doomsday. But I think the third scenario, the multipolar world, bilateral agreements, FTAs, some de-dollarization and local currency strengthening, and some selective capex, and realignment of trade is the most likely scenario that we are looking at going forward.
Thank you so much, Madhur. That's a lot of
Bruce will
detailed
take us through.
content. Yes, indeed. Just started. No, thank you. I was just thanking you for the very detailed overview of the different forces at play, the power center axis and the geopolitical bloc or the exporter axis. I think it's fabulous, and we'll see that continuing to happen. And if you're listening in, we will come back to sort of how the situation evolves even over the near future in subsequent webinars. Now, the big question and what we promised is, what does it mean for you as an industry leader or as a supply chain leader? And this slide encapsulates that in three levels. The first is the CEO or the business leader agenda. The second is the operations or the supply chain leaders agenda. And the third is the financial perspective. And I'll walk you through each one of them. So from a strategic lens, there are a few imperatives. The first is be open to opportunistic M&A. Any short-term upending of relationships always create stresses, and these always lead to very attractive M&A opportunities. These could be exporters who are overloaded with with inventory looking for support. These could be business models that are all of a sudden under stress because the country has been imposed with a lot of tariffs. But really having a sharp eye on opportunistic M&A over the next few months is incredibly powerful. Second, the one thing that is guaranteed from all of this is reshoring. So establishing a reshoring control tower within your organization is important. Now, what does that mean? That means ears close to the ground, watching out for tariff changes that are likely to come up, having a view of different scenarios of tariff imbalances and therefore how the future supply chains could play out is incredibly important and critical, because everything at the end of the day comes as a result of these tariffs and these global flows. So having a perspective on that is important. Third, the leaders need to really focus on what impact can be passed on and needs to be passed on to end consumers. The good thing about this crisis is the entire world is aware of this crisis. It's not just in the B2B space, but already impacting B2C. So leveraging that and figuring out how the pain is shared is a very important conversation to have. And a related point is about setting the right expectations also with your investors. This is a time to look long-term and not necessarily in terms of short-term returns from an investment perspective. An important opportunity is also to refresh risk processes. Business continuity plans have been laid over the last 10, 20 years, and there's an important opportunity to sort of bring it back into the organization's vocabulary and refresh a lot of the risk processes. It will really strengthen you and your organization. Rallying the organization around this burning platform, they say crises are actually opportunities, and this is a great sort of opportunity to rally the entire organization and sort of have one war cry towards the direction that you want the organization to go. So there's a very active CEO agenda, a lot of positives that we'd actually see as against only defensive measures. And then as we go to the operational lens, also a very exciting agenda there. First step is to build intricate supply chain visibility. Supply chain leaders need to know the health of their suppliers. They need to know alternate suppliers. They need to know the risks of the trade routes that those suppliers take in order to get their goods to your show. Very, very important, especially for the Middle East. Second, you need to diversify. Diversification is the single most trusted risk lever that is available in supply chains today. But diversify not just across supplier tier or not just to another supplier, but across geopolitical blocks. So if you're procuring from a Chinese supplier historically, then look for somebody from Asia or from other geopolitical blocks that are not sort of aligned with China. And similarly, vice versa. So this is extremely important. Building dual sourcing capability where you have an A team that can run business as usual when things are calm, but also have, let's say, a B team or another persona of the team that can react in times of quick crisis and optimize for availability as against cost. So this is a unique sort of ambidextrous capability that you need to build, strongly recommended. Many organizations are already in that direction. Last but not the least, within operational is also to rethink talent and supply chain footprint, because talent will also get very quickly constrained in terms of their mobility. So for global organizations, think about your talent sources and sort of, where they need to be. From a financial lens perspective, again, there are great insights for finance leaders. The first is around trade finance. It's a very interesting situation right now. There could be great opportunities for trade financiers, especially those who are positioned across multiple geographies. You need to build risk transfer strategies via insurance. Insurers are also quite busy over the last few weeks. And most importantly, if you have a global setup and a sizable organization, you do need to hedge against inflation, against FX exposures, especially as the dollar, seems softer now than ever before. So it's a very exciting agenda across the leadership level, at an organization level, at a supply chain leadership, and also from a finance leadership. I deep dive briefly into operational questions across 4 dimensions in this slide. There are four key areas that we'd like you to think of if you're a supply chain leader or a procurement leader. The first is supply continuity and switching costs. So, when you look at switching costs of going to the next best supplier and having diversification, a couple of things that you need to think about: building up inventory, managing inventory more sharply around tariffs, using negotiations and supplier relations as a great lever in order to manage switching costs. I think that's an incredible place and an incredible lever to focus on. Dual sourcing. Now, this refers to sort of having a business as usual sourcing where you focus and buy from your most important supplier, but you also need to have your backup supplier for that category ready and engaged, even if they are at a higher price. And that's very important to have alternates. Managing potential price differences. On the compliance and regulatory side, there's an increased risk of audits and penalties. You need to have a very close watch on regulations. There are longer processing times in general. The stocks that are likely to get piled up in ports, because this sort of volatility in tariffs hasn't happened for a long time, you need to add buffer time. And then from a talent and location perspective, of course, you need to incorporate flexibility to relocate teams for multinational organizations. So it's a very exciting agenda. Great opportunities if you can build deep supplier relationships, in-depth supplier negotiations, and have great visibility on how your supply chain is actually feeding your operations. With that, I hand it back to Kumar for a few additional closing thoughts. Over to you, Kumar.
Thank you, Arun. So we heard some very interesting insights from our amazing panelists in each of the regions. Europe, the need for them to become self-sufficient both in defense as well as a trade. The US, to drive tech investments within the company and to shore up the manufacturing that seems to have flown away from the US for quite some time. And the Middle East and India as opportunities, being fairly neutral in this entire scenario for investments as well as trade agreements. I think as CEOs look at this and look at the future alignments that might occur over the next few years, I think they need to pay attention to what I would say is three effects. The first, I would say, is the first order effect, is that your things are going to cost more. If your things are going to cost more, you need to figure out how exactly they will cost more and what will they mean for the product cost. And so, and how do you counter that? Is that going to make a difference in your market? Can you pass on any price increases to the customer? So what will be our strategy for each of the supply impacts, that first order impacts that will occur? Then there's a second order impact, and the second order impact should be thought of very carefully along with the first order, which is that the demand is likely to go down for some products in the short run. Especially if the pocketbooks in the US are hit hard, then they will stop buying for a little bit, wait and watch out for what is going to happen next. Countries like the European Union as well as Canada have stopped buying US goods from a purely nationalistic sentiment. So demand is going to go down. And if the demand is going to go down, CEOs must worry about figuring out how to conserve margins in the short run. And the third order effect, which is the one that cost most of us short in the semiconductor crisis, is what happens when you may have a supplier who's directly, the US organization may have a supplier that's directly US, and therefore no tariffs impact. But the supplier themselves may be impacted by suppliers and may close down certain product lines. So there's a capacity shortage in the short run that you need to think of. And so while we're addressing the first order impact, it is very important to keep an eye out for the second order and the third order impacts, and therefore be able to respond in the short and the long run. Thank you very much for listening to this, and it has been a great conversation so far. And let's take a few last questions here.
Thank you, Kumar, for those beautiful closing thoughts across those three areas. So we have one question on the common currency and RCEP, the topic that Sunil you mentioned. If we can pull that up, please. If you could unmute, please.
Thank you, Sal, for this question. Quite a relevant question given how BRICS has been evolving. So, a couple of thoughts on this. The BRICS summit recently had almost 13 nations signing up beyond the traditional members. So, we have a lot more people joining this organization now. I'll try to break this down into 4 points. First is the shared vision. Now, the BRICS is not a homogeneous group, and hence, while the Brazilian president was enthusiastic about this idea and supported by Russia, you must have seen that South Africa, India, and particularly China were conspicuously quiet on this topic. The second is, the time to execute. Something like this takes a long time to execute. The euro was created in 1999, almost 30 years after the Werner report. Uh, so it took a long time to come up with a common currency for something like the European Union. And the third thing is maintaining exchange rates for a common currency. A single currency requires single interest rates, which are necessary across nations, and we have this very wide disparate nations over here at different levels of economic growth. And the fourth is influence of China. China's relative dominance within the BRICS is way more than what Germany was in EU. China today contributes almost 70% of the BRICS output compared to Germany, which was about 30% at that point. So given these four factors, the chance of a BRICS currency becoming dominant or becoming important in the future seems low. It seems like China would like to push RMB to be an international currency, and it might not be in near future that we see BRICS currency coming to dominance.
Thank you, Sunil. There's a question on innovation in semiconductors, Kumar, that's right up your alley. If you'd like to take that, please.
Well, I think the innovation will be fine. I think the innovation will be spurred. If you look at the semiconductor industry, we can think of it in two terms. One is the wafer manufacture, which is predominantly being done in Taiwan now through the major Taiwanese companies, and to a certain extent in China and in Korea. And then there is a design of semiconductors that's predominantly done in the US. There will be significant investment in other countries like India and the US to ramp up back the semiconductor manufacturing, and that takes time. It's not a semiconductor plant and investment takes about 10 to 20 years. So it's a long-term desire, which I think will still be good. I don't see any stop to innovation because innovation is largely driven by new products, new apps that are coming across. That is still going to happen. And so I'm not worried about innovation in the semiconductor industry. I'm a little worried about what happens to Taiwan, because that's where most of the wafers are produced right now.
Great. We're almost at the hour, and this has been an incredible hour with so many of you joining live and with our illustrious set of fellow panelists. We talked about multiple topics. We talked about how tariffs were weaponized in the past. We talked about where the tariffs are today, the different scenarios that the entire tariff war could actually take, and most importantly, we talked of implications for leaders from across the world. So we really do hope that you, as dear audience, you were able to take out quite a few important points. Thanks so much for the engagement. Let me thank Kumar, who's joined early his time from the East Coast. Thank you, Madhur. It's quite late in India. And thank you so much, Sunil, and the broader team. Thank you, everyone. And do watch this space. We will be coming out with a further set of webinars on this very important topic. Thank you.
Thank you all.